You're throwing out all the old stuff into the dumpster. Why should we give you benefits on that? It's not there anymore. And we'll give you benefits on the new stuff that you put in, the new cabinetry and the new flooring. Great. You'll send us your renovation budget, and we'll depreciate as much as we can.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. I've got a great guest today, Isaac Weinberger, and we're here to talk about cost segregation. So Isaac, thanks for coming on the show.
Absolutely. Thank you so much, Jack, for the invitation. I love getting on the show, getting on podcast shows with great hosts like you who've done deals, and I'm very excited.
Yeah, and we're practically neighbors too. So I grew up in Jackson, which is one town over from where your office is. Are you from Lakewood originally? Did you move down from the city, or? So
that's actually a very interesting question. I actually grew up in Detroit, Michigan, in the Midwest, but many of my relatives and friends live in the Jackson area. So I've been there multiple times. I just spent the weekend in one of the areas of Jackson. Beautiful, beautiful place. Many people think that you only get nice places in Miami, Puerto Rico, and California. It's definitely some nice places over here in New Jersey.
Yeah, no, everyone bashes New Jersey. They think of like the Sopranos and like that whole area by the turnpike. But yeah, once you get, once you get an hour outside the city, I mean, there's some great areas in Ocean Monmouth County and then up in Bergen County. So, yeah.
Exactly.
Shout out to New Jersey. Let's dive in. I talk a lot about depreciation and tax savings, but we haven't really ever did a deep dive. If you could just give the high level to, what accelerated depreciation is and what goes into the cost segregation and really how you guys do what you do.
Absolutely. So the way I like to break it down, and obviously this is a topic I talk about every day, multiple times a day to potential clients and clients on a podcast and at meetups and networking events. And it's become my favorite topic. And my wife tells me that it's coming out of her ears. She hears it all the time. But this is my job, and I'm proud of it, and I love it. I think it's one of the most important tools in real estate investing is cost segregation. And I like to show you guys, everybody watching this fabulous show, exactly how it works. So the way I personally like to break down cost segregation is into three different parts. There were three different three different parts of depreciation that really came together as one that we're dealing with right now. And the way I'll start is like this. We all know what regular depreciation is. Anytime you buy an investment property, you're entitled to depreciation, which is actually interesting because a lot of the reason why we are in real estate is because of appreciation. Properties go up in value. So how in the world am I getting depreciation benefits if it's going up in value? And the answer is that even though your property is going up in value, the IRS views that your property is going down in value due to the fact that it's older, so you're really gaining and benefiting from both sides of the spectrum. So regular depreciation will dictate if you buy a $1 million residential property, whether it's single family or multifamily, you will get approximately $30,000 a year for 27 and a half years. As a deduction. So if you make $200,000 that year, it will lower your tax liability. It will lower your taxes, your taxable income to $170,000, and obviously that will result in you paying less taxes. That's standard depreciation that your accountant will do for you, even if you don't know about that. Cost segregation prior to 2017, prior to September of 2017, was like this. There's three different components in every single property. There's structure, which depreciates over 27 and a half years. There's land improvements, which is landscaping, parking lots, asphalt, that depreciates over 15 years. Then there's chandeliers, cabinetry, light bulbs, door handles. That all depreciates over 5 years. A regular accountant throws all three under long-term depreciation. Therefore, you're not getting certain components that you could technically get faster on a faster track. You're not receiving that. A cost segregation study really consists of a cost segregation team coming into the property, identifying the components that technically can be taken faster, and putting them and reclassifying them from 27.5-year or 39-year by commercial into 5 and 15-year buckets. So that will allow you to receive benefits over a faster time track. That was prior to 2017. What happened in September of 2017 was something called bonus depreciation, and that's how I started off. There's 3 different parts of cost segregation, of depreciation. There was the regular depreciation, there was cost segregation prior to 2017, and then there was bonus depreciation, which was introduced in September of 2017. Bonus depreciation allows for all 5 and 15-year components to be taken on year 1. Up until 2023. We'll talk about what changed in 2023, but up until 2023, any properties placed into service prior to 2023, any components that we identified as 5 and 15-year components can be taken on year 1. So I'll just recap for a second. If we come into a property and we identify 20% of the purchase price as 5 and 15-year components, prior to 2017, you could only take that over a 5 and 15-year period, which is great. Post 2017, you can take all those 5 and 15-year components on year 1. So if you bought a property for $1 million, instead of taking 30 grand a year, you possibly can take 200 grand in year 1 or more due to bonus depreciation. So that's the basic breakdown of how depreciation and how accelerated depreciation works.
And let me give a quick real-world example here. We had multiple investments where I think we got closer to 30% of the value, and we were borrowing 70% of the value from the bank. So we had deals where we put in $100,000 and received a $100,000 tax loss on our K1. And actually 1 or 2 deals was over 100%, where I think leverage was 75% and we had 30% or so. So it's really amazing. And if you're at the top tax bracket, whether it's because you have a lot of rental properties, you're a real estate professional, if you can take all the deductions, you're saving between 30 and 42% on your taxes. If you're in the top tax bracket in New York, New Jersey, California, all the high tax states, it's amazing. It's 42 cents on the dollar when you factor in federal and state income tax. So it's extremely powerful.
Yeah, so that's a really great point that you just brought up, Jack. Many times guys will ask me, hey, I have 2 identical properties. Why did this property get more than the other one? And the answer is that, first of all, like you said, it's not just 20%. It really depends on the property. Sometimes it could be 30%, 32%. It really depends how much common area there are. Is there tennis courts? Are there swimming pools? Is there a lot of grassy landscaped areas? That all adds more percentage onto the cost segregation. But you brought up a very good point. It's all dependent on how much LTV you have. For example, if you have seller financing and you're not putting down a dime, your benefit of cost segregation is going to be that much higher. Because if you don't get good leverage and you're raising a crazy amount of equity, that means per dollar invested, you're just getting less amounts of accelerated depreciation. So that's a great example how every single situation varies on how it's structured.
So we deal a lot in the syndicated asset classes, and I've got the most experience with multifamily and then a little bit of storage. Where do these asset classes rank as far as, in general, the highest percentage of cost seg? If you could kind of rank the multifamily, mobile home, storage, and I guess RV parks. I don't know, just kind of go in order.
Exactly. So I'm going to start from the lowest to highest. I love doing this. It's something that everybody has to know because there are certain times that people go into properties just for depreciation benefits. And obviously make sure it's cash flowing. Don't buy a bad property. But very important to know, the lowest asset class for depreciation benefits are self-storage. Now, don't just call it off and say, hey, I have a self-storage property, we're not going to do it. The reason why self-storage does not get such a high percentage is because they're hollow inside. So there's not too many components for us to accelerate. As opposed to, let's say, a multifamily property, you got cabinetry, you got vinyl flooring, you got all these things. Self-storage generally gets anywhere from 7 to 15% of the purchase price. There are cases if there's a huge parking lot or special HVAC system, special types of electrical, you will get more. The self-storage and industrial are generally the lowest in terms of percentages. The next up are offices and retail. You get a nice amount, anywhere from 10 to 25%. Again, it really depends on the parking lots and what you have in the store, what type of flooring you have. Do you have a lot of shelving? Do you not have a lot of shelving? Then that's the next one that I would say. The next one I would say is single-family houses. Single-family houses get anywhere from 10 to 25% as well. Generally, I see them coming back at around 18%. And the reason being is that the kitchens are usually not too big. Generally, the front yard and backyard are not too big either. If you have a country-style single-family property, you will get more. I just got a country-style single-family property for a client, 30%, because there was a huge basketball court in the backyard, a huge swimming pool. But generally, single-family houses, you'll get anywhere from 10 to 25%. Now, we'll get into the asset classes that we're more involved in. Multifamily is obviously the property that we're dealing with the most, because that's what most guys are into. Multifamily properties will get anywhere from 17 to 32%. And I want to run through quickly what will dictate in multifamily properties you getting more. If you have a walk-up style multifamily property, let's say in Manhattan, where there's no parking lot, and it's a brick building, brick buildings get less because it's harder to classify brick as land improvements and non-structural component, as opposed to when you have regular siding, it's easier for us to go ahead and classify certain components of the siding as 5 and 15-year assets. So if you have a walk-up style property and it's brick, and it's hard rear flooring, so you don't have the nice new vinyl flooring, very little cabinetry, you'll get more to the 16, 17%. But when you have a garden-style property and you have common area and it's not brick, and I do a lot of these properties, we're talking about 25, 27, 30% of the purchase price in year one. That is multifamily properties, so no two multifamily properties are created equal. Something important to know. The next asset class that is one of the most beneficial asset classes in cost segregation, in the cost segregation world, are mobile home parks. And the reason is like this. What's the reason why we can only get you 30% of your purchase price on multifamily? The answer is because the structure, which obviously a lot of the purchase is allocated towards the structure, that's 27.5-year property. But in a mobile home park, a lot of the actual structure is considered 5 and 15-year assets. And therefore, that will allow us to accelerate much more than the average property. I've gotten clients back on mobile home parks anywhere from 60 to 80% of the purchase price. Now, it's very important to note that's only if you own the home. So it's a park-owned home. Some people only buy the actual land of a mobile home park and they rent out the spots to people that own the actual mobile homes. Then you have nothing to accelerate because you don't own anything. You only own the land. The land is not depreciable. Two more things I'll end off with that a lot of people don't know. Gas stations and car washes. There were certain laws that went into effect a few years ago that classified almost the entire car wash and almost the entire gas station as a 15-year component. That will allow a gas station owner and a car wash owner, not just the business, he has to own the entire property, will allow them to take close to 100% of the purchase price in year one minus the land, because land is not depreciable. So let's say you bought $1 million property, 15% is land, is $850. I would not be surprised if you get close to $800,000 in year one, which is incredible. I just did a car wash for a guy, 2 car washes, $11 million. He's getting back $9 million out of the $11 million as first year benefits, which is incredible, because even if he doesn't need all $9 million in year one, it rolls over on his tax returns indefinitely for years to come.
Yeah, that is incredible, and it's incredibly powerful. And especially with the potential sunset of bonus depreciation, it's really good to bank it while we can. Now, obviously, neither of us are CPAs, but I think at a high level, that 2017 rule change that allowed for 100% bonus depreciation. I know in 2023 it's dropping to 80% and then down to 60%. I mean, you guys being so heavy in the business, are you aware of any kind of lobbying efforts to reinstate it, or is there anything in the industry going on that you may be aware of on what's happening with those IRS rules?
So that's a great point. Many of the real estate people believe that it really will just take a change in whether it's Congress, and that's already happening, for this to be either postponed or completely, changed around. Now, I just want to bring out a point, Jack, is that regardless of whether or not this changes, let's say you're right and everything stays status quo, everything stays as predicted, that it's going to be 80% this year, 60 next year, 40 the next year. Something that everybody has to realize is that even prior to 2017, cost segregation was very beneficial. So you're not going to be getting as much, and you might have to do more properties in order to add up to the amount that you're used to. But cost segregation will always be in effect in terms of accelerating 27.5 and 39-year components into 5 and 15-year buckets, which will get you faster depreciation. Obviously, as more Republicans come into the House, they're obviously pushing more for real estate benefits. Let's see what happens. But I'm obviously, as a cost seg guy, I'm like, hey, what's going to happen? But because I know that prior to 2017, Madison Specs as a company did a tremendous amount of work, we know there's a lot of work still to be done.
It's a great answer. And again, neither of us have a crystal ball, but I completely agree. And, I feel like it is a bipartisan issue. There's a lot of rich Democrats that own real estate as well. Hopefully something gets renewed. What is the process? So somebody buys a building and they're interested in doing cost seg. What is the process? Does someone literally have to go into a majority of the apartments, or can most of it be done kind of virtually through, floor plans and budgeting? And especially with the multifamily, with the heavy value add component, I know to some extent you could double dip. You could depreciate the old equipment, the old kitchens and the new kitchens. Maybe talk through a little bit of that, like what does someone need to provide you, and what is the time frame in the process?
And great questions, Jack. So, and this is so important, because the double dipping we'll get to in a second. That's something that every guy has to know, and it's something I try to educate people on. You know what? Let's get into that right away. What does double dipping mean on renovations? We'll get into the other questions. You buy a property in January of 2023, and you want to gut every single unit and completely redo it. The IRS tells you, hey, you're throwing out all the old stuff into the dumpster. Why should we give you benefits on that? It's not there anymore. And I will give you benefits on the new stuff that you put in, the new cabinetry and the new flooring. Great. You'll send us your renovation budget, and we'll depreciate as much as we can. So if you do it in the same calendar year, you buy it in January, February you start renovations, you finish in June, okay? Then there's no double dipping. You'll only be able to depreciate the new stuff. The old stuff will not be able to be included in the cost segregation study, and you will lose out a lot. Smart way to do it. Smart way to do it is you buy a property, and obviously it's not going to always work out like this. You buy a property in September, okay? A 200 unit multifamily property in September, and you start renovations the next January. You buy it in September of 2023, and you start renovations in January of 2024. You can double dip. You can do a cost segregation study on the full purchase of 2023. We'll capture everything, even the old stuff that you threw in the garbage, that you're going to throw in the garbage in January. And then we could do a new study for the renovations that you put in, allowing you to take a tremendous amount of benefits. So it's all dependent on the calendar year. Did you buy and renovate and finish the renovation in the same calendar year, or was it two separate calendar years? That's what I call, and that's what we call double dipping, which is a tremendous way to maximize your depreciation. Other points you brought up, which is very important as well, is physical, virtual tours. How does it work? So prior to COVID, Madison Specs were performing a tremendous amount of physical tours. We're flying out we actually had to charge the clients to drop more because we needed hotel stays and flights. And during COVID, which obviously limited flights and limited our ability to get down to the property, we actually contacted the IRS and we asked them, hey, what do we do? And they said that a virtual tour will suffice. And we actually found that the virtual tours are tremendous because we videoed them and we obviously we recap the video we took and we look it over slowly and we really capture every single nook and cranny, every single little small corner, and depreciate every last light bulb that we can. So there's no physical tour needed anymore. Sometimes people want them, which we're happy to accommodate. Usually at single family houses, we don't even need a virtual tour. The documents and pictures and videos are generally enough. But everything that we do as a company is IRS, within the guidelines of the IRS. But a guy buys a property, just to get into the last point you pointed out, the guy buys a property, you buy it for $1 million. Hey, how do I get the cost seg study started? You send it to us for a proposal. You send us the address, the purchase price, and closing date. We send you back a complimentary proposal. You look at it. We review it with you. We see if it makes sense. We engage. We ask for some more documents. We come down to the property either through a virtual tour or a physical tour, and then we send you anywhere from 4 to 6 weeks later a completed study, a 70 to 90 page report that is reviewed by your CPA, and then from there you're good to go.
So we're in March right now, and this will probably come out within a few weeks. Is it too late to do something for 2022?
Great question. Somebody who's filing for the March 15th deadline, obviously it's too late. For the April 15th deadline, we possibly could squeeze it in. If you're filing for an extension, then it's not too late at all. And something that many people don't know is that I just engaged with a client with a big study to amend his 2021 tax returns. He did not know about cost seg, and he had a few properties, and he actually amended it. And it could be there's a few penalties. I don't even know if there's a few penalties, but obviously the gain that he was getting from us was worth it to amend that. So it's not too late. If you plan on filing in March or April and you have some properties that you like to go ahead and cost seg, file for an extension, do the cost seg, and then definitely don't lose out from the benefits of a cost seg.
Great. And I've seen some of the complimentary proposals. How close are they to the final product? Is it within, a couple percent typically?
I've been on tens of podcasts, and this is the first time I got this question, and I'm so happy that you're asking it because it's such an important part of what Madison does. So I'll never put down another company. There's some great firms out there, great cost segregation firms. Madison's approach is a drop different. Their approach is under promise and over perform. We don't want to go ahead and give a number. You got a $1 million property. We're going to give you $350,000, and we come back to you 3 weeks later, and we're like, hey, we only were able to reach 310. And obviously you were banking on the 350. Our approach is a drop different. We're as aggressive as possible in a conservative way. So our projection is generally, the final results of our study generally beat our projection by anywhere from 1.5% to 10%. So many times it's very hard for us in a proposal to see every single nook and cranny, every single little piece of the property. So therefore we won't be able to get it 100% accurate. It's only 95% accurate. So we try our best, obviously. I've seen the final studies of many clients come back much higher than the projections, which obviously they get super excited about because, hey, I wasn't expecting this. But many clients will be like, hey, Isaac, I need a little bit more. And I'll go to the engineer and be like, hey, could we try to push a little more? Do you see anything more? And we'll come back with higher numbers. But the point is that on the actual study, we get much more because there's much more in the study that we see that we didn't see in the projection.
That's great to hear. Let's talk a little bit about the single family again. I know most of my experience is with larger multis, and in my opinion, the multis, it's a no-brainer. It makes sense across the board. Where do you think the break-even is on a single family? And is the actual report a little bit less expensive as well than, say, a 200 unit with a lot more components? So for someone who maybe owns 2 or 3 single family houses, whether they're Airbnb or just long-term rentals, like at what point does it typically make sense for those clients?
Exactly. Great question. So a single family house, when people ask me this question, I say anywhere from $275,000 and above of a purchase price. And I'll explain why. Let's say you give me a $200,000 single family house, and I get you, we have to subtract land. So let's say land is going to be 15%. So we're going to take off, $30,000, I believe. So we're down to 190. Let's say we get you, let's say even in best case scenario in a single family house, we get you 20%. So we're going to get you 190 times 20% is $38,000. Let's say you're in the 25% bracket. A lot of these single family guys are not in the 37.5% bracket. So let's say they're in the 25% tax bracket. Times 25% will be $9,500 of liquid cash saved that you did not have to pay the IRS. We charge for a single family house anywhere from $3,000 to $3,500. Multifamily is anywhere from $5,000 to $6,000. Single families are anywhere from $3,000 to $3,500. So for us, if you can find a cheaper company that does good work, go for it. But for us, there's only a $6,000 swing. We say, hey, it doesn't really make sense to do it over here. But when it comes to, let's say, a $250,000, $275,000 house, then, hey, there's going to be a $10,000 swing. So it does justify to pay the couple $1,000s to get an extra $10,000 in your pocket. So it also really depends, because if you have a $200,000 Airbnb that's on a huge swath of land, and we're going to be able to get you 30% from that, then it is worth it. But the average single family house that I've seen, and I've run through hundreds of them in the past couple of years, generally I would say the rule of thumb is $250,000 to $275,000 and above. That's when it makes sense to actually contemplate it. I'm not saying it's going to be worth it to do. That's what I would say, yeah. But for example, if you have a $300,000 house in the heart of the city, I don't know if you know if they make those, but like walk up, there's no parking lot, no front yard, no backyard. It's a rundown old place, and we're not going to be able to get you too much benefit. It won't make sense. But yeah.
So it's interesting. Obviously, you need to subtract the value of the land, but it sounds like if you actually have some acreage, that actually raises the percentage because of, I guess, the parking lots and the landscaping. And
it's such a good point, Jack, because let's say you buy a small little structure on a huge 2-acre property, right? So you would think, hey, the land value over here is much more. You're going to allocate a lot more to the land than to the house, right? There's not going to be too much basis left in the house. The answer is sometimes it works that way, but many times, especially in certain areas that are not so popular, many times there's very little allocated towards the land, even on a big portion of land. And if you don't have any structure there, you'd be done. There's nothing to do. But as long as you have a little structure there, that could go ahead and really give you a big benefit.
That's great. That's great advice. Is there anything different on the short-term rental that is more efficient than, say, a long-term rental? Because I know a number of W-2 employees are trying to play that game where they sort of get one Airbnb, they put it in service in December, they're the only one that's doing all the work, so they qualify, and it's really a loophole to offset some active income, and then the following year it becomes passive again. Is there anything different about short-term rentals than longer-term rentals?
Yeah, so that's a great point. First of all, short-term rentals are depreciated over 39 years, as opposed to long-term rentals, they're depreciated over 27 and a half years. Just good to know. So you have a great point. We see many times, and many CPAs, especially on LinkedIn, post about this all the time. There's a certain loophole, and that's true. In order to become a real estate professional, you need to spend 750 hours a year or more in real estate services. If somebody's on a W-2, it's very, very hard to be a real estate professional because the IRS says, hey, you're working from 9 to 5. Where do you have 750 hours a year to actually participate in real estate? By short-term rentals, there's a certain law that I think it's either 125 or 150 hours. When you spend by yourself 150 hours, you're able to actually use a certain amount of the depreciation from the short-term rental to offset active income. Generally, the only way you could offset active income is if you're a real estate professional. If you're a real estate professional and you're doing an Amazon hustle on the side, you could use your depreciation from real estate to offset your Amazon income. But if you're not a real estate professional, all you can do with the depreciation is to offset passive income. So K1, stock market proceeds, etc. But by short-term rentals, there is that loophole. If you spend X amount of hours in the short-term rental, you could actually use a certain amount of that depreciation to offset actually active income. So that's definitely a plus.
Yeah, and things like the furniture, most short-term rentals are fully furnished. So, if you spend $50,000 between couches, pictures, bedding, is that all generally, I assume, in the 5-year or less category? So that's all, I assume that's all bonus depreciation, or is there a different?
It's a great point, and again, something that every listener here has to know. And Jack, you really nailed it with these questions because you're really coming down and nailing out every single important point. So it's something called FF&E. So that generally goes by multifamily and hotels, but by short-term rentals and long-term rentals, this is very important to note as well. If you purchase the property, and then after you purchase the property, you purchase the furniture and put it in, it does not add to the basis of the purchase price, and we won't really be able to do anything for you on the furniture side of things. If you purchase the property together with the furniture, for example, you purchase property for $1 million, and there's $200,000 worth of furniture inside the property, in our eyes, in terms of depreciation, your basis number will be 1.2. So it's incredible. You bought a property for $1 million, and you're dealing with a basis of 1.2 because there's furniture inside.
That's a great point, and thank you for sharing that. Any other tips or just advice you give to those that are kind of newer to cost seg and that are thinking about exploring that as a tax efficiency? Absolutely.
2 tips. I've been hounded recently, especially on my LinkedIn, about guys that they told me that their CPA doesn't know about cost seg. If you're in real estate, even if you're only partially in real estate, make sure you have a CPA that knows the real estate laws. It's not just for cost seg. It's for 1031. It's for all the real estate loopholes, legal loopholes that you could benefit from. Make sure you have a CPA that knows what he's talking about in terms of real estate. The second thing that I'll tell you is partnership agreement terms. And this is something important for every syndicator to know. So the classic split between syndicators and investors are 70-30. Okay, sometimes it's 95-5 before the refi, and then after the refi it becomes 70-30. Whatever the idea is, there's something called partnership agreement terms where you can give away portions of your depreciation. Many guys call me up and they say, hey, Isaac, I'm on a W-2, so I'm not going to benefit from cost seg because I don't have a lot of passive income. My partner is not on a W-2. He's a real estate professional. He will benefit. What should we do? I don't want to do the cost seg. He wants to do the cost seg. The answer is first of all, you don't lose out anything from doing the cost seg because your rights and your benefits will just roll over on your tax return. But second of all, you can actually go ahead and give away your portion of depreciation to your partner, which will benefit him tremendously because he's a real estate professional. He could either pay you for that. Whatever it could be. It's sometimes when you're syndicating a deal and you have a guy that's deciding between, hey, Jack's deal, and he's deciding between Mark's deal. And Jack is like, hey, I'm going to give you more depreciation. He's like, hey, I'll take it. Because a lot of times the syndicators themselves, they don't really need the losses. They have enough real estate losses, and they give away portions of their depreciation to their investors. Instead of giving them the classic splits, they're giving them a little more because it doesn't make a difference to them. Speak to your tax attorney. Speak to your CPA. There are ways to alter your partnership agreement terms to allow others to take more depreciation than the classic regular splits.
Yeah. Isaac, you're bringing a smile to my face here. That's we're speaking the same language. I've actually been in a few of those deals, especially with the amount of people who have self-directed retirement accounts. And, there's obviously some UBIT issues for potential certain retirement accounts, but I know those that have the solo 401k, there's no UBIT, but they don't really need the depreciation. So I've seen a few deals where, self-directed retirement accounts are set up as preferred equity. They make a similar return, but you actually give them a slightly higher, maybe a higher preferred return, or just that you pay them first in the waterfall, give them a little less risk in exchange for giving away their, a majority of the depreciation. And it's super powerful. I had a deal in our fund that we got 2-to-1 because of the way it was structured with depreciation. So we'd had a sale that year as well. So we took the sale proceeds, put the principal into a new deal to get 2-to-1 depreciation, and it offset what we would have had as a gain. So it's super powerful, and I expect with the bonus depreciation dropping to 80%, I think there'll be more deals engineered that way in the coming years.
I like that. Exactly. Very cool.
I do want to point out, obviously, we haven't really talked about recapture, and this isn't really a full tax podcast, but the other side of the coin is there is potential recapture in the future. Yeah, we work with a lot of people nearing the retirement age, and a lot of what my advice is take the deductions now, and you deal with the recapture later, and you try to reinvest and take more depreciation. But it is more of an active monitoring. I keep a spreadsheet. I encourage people, if you start going down this rabbit hole here, you need to track your basis and be strategic on your sale. You did mention 1031s. There's also just strategically redeploying into deals with significant future cost seg, and or just refinancing out for a tax, just a non-taxable event to pull some cash out in the future. So there's multiple ways to mitigate it. And for those that are approaching retirement, the other real key concept is, if you're at the top tax bracket now, maybe you're going to move to Florida where there's no state tax. So, if and when there's recapture in the future, the goal is it gets recaptured at a lower tax rate than your current bracket.
I just want to chime in right there. So, Jack, this is obviously very important to bring up. And there's always two sides to a coin, and recapture is something that you have to consider. And this is something I talk about with every single client of mine. Are you going to sell within X amount of time? Generally, I tell clients, if you're going to sell within a year or two and you're not going to 1031 the property, it might not make sense unless it's a huge purchase. But something you're bringing up that is so important, besides the fact that the main reason to do cost seg is time value money. So even if you're going to sell it after a few years, you have access to that cash and those tax deductions for the years right now, just like a 1031. But something important to know is, like you said something that if you move to Florida, where it has lower tax brackets, you'll get recaptured at a lower bracket than what you were able to offset initially. But something just to keep in mind along that same track is you're able to use depreciation to offset ordinary income at 37.5%. Recapture, it's a debate out there, but a lot of the recapture is maxed out by 25%. So right there's a 12.5% swing that will actually make sense for you to go ahead and do a cost seg, because if you're getting hit in the 37.5% bracket, you're actually saving yourself a lot of money.
Yeah, that's a great point. It's the standard depreciation is recaptured at 25. It's just the bonus portion of it that actually is recaptured at ordinary income. Is that correct?
Right.
Yeah.
I think so.
We're not CPAs ourselves,
so it's not going to be up. It's not going to be right. It's not going to be a full 37.5%. So you will be gaining. Yes.
Yeah. I mean, and for those that are real estate professionals, or one of my other favorite loopholes is the spouse is a real estate professional. If you're married filing jointly and one spouse can qualify, everything is blended together. So that's super powerful. With that said, the advice I've constantly gotten is you have to document, especially if it's going to be your first year filing and your tax bill is, you go from paying hundreds of thousands to paying zero. You're probably going to show up on some spreadsheet or pop up in some database because of just the amount of taxes you're paying. So the documentation is key. I was just listening to a prominent IRA tax attorney who was going through some tips, and he's like, if you do get audited, you can't show a sheet that shows you have exactly 750 hours, and it's obvious you made it up, once you got the letter for the audit. You need to have meticulous tracking, and ultimately, if there's an inquiry, the IRS is going to focus on those that are disorganized and don't have their stuff together. And if you've got a very detailed spreadsheet documentation of all the time you've spent, they're more likely to say this is not worth fighting. These people they're very organized. They have their stuff together. We're not going to win this case. We're going to go after the low-hanging fruit of somebody who's, just disorganized and can't prove out their hours.
Unbelievable. I just want to let you know that I'm a little scared right now. You're so knowledgeable about cost seg. I'm scared you're going to become the next cost seg expert, and you're going to take over my job.
That's all right. I don't want to get that into the weeds, but happy to refer business and just get the word out there. And
you're good. You're very good. But that's a great point. This is something that I talk about with many people. And to be honest, this is something that I talk about with my wife a lot. I told her, the second I make X amount of dollars, you're quitting your job, you're buying real estate, you're becoming the real estate professional, and you're going to offset my W-2 income. So this is a tremendous way. But like Jack said, if you're going to do this, make sure you document it. Make sure you do that, because even if you have those hours and you have the properties that you bought, they're going to go after you if you're disorganized. Make sure that your wife's name is on some of the purchases. She's doing some of the property management. Your actually documenting it. Very important points, Jack.
Neither of us are CPAs, so consult your tax advisors about that. And it's important to have, as you said before, a CPA that's very familiar. I know a number of them through some of the mastermind organizations I'm a part of that focus heavily on those that are real estate professionals and can provide the proper guidance. So Isaac, this was an awesome episode. You dropped a ton of knowledge. Tell everyone how they can get a hold of you.
Absolutely. So I'm the most active on LinkedIn. My name is Isaac Weinberger, Cost Seg Isaac. That's my title. I show up every day there, but obviously I would be happy, Jack, for you to share my email and phone number. I'd love to connect with you. If you have any questions, don't be shy. Even if it's a small STR, shout me out and I'll help you out.
Awesome. Yeah. Well, and we'll put all your information in the show notes and whatever you want to share. If you want to have your LinkedIn profile, we can put a link to it. Thanks again for doing this. And I encourage all of our listeners, please, if you like our podcast, give us a 5-star review on iTunes or Spotify. We also will post this on YouTube. So check out our YouTube channel. And thanks again for listening. We'll see you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.